Okay, let's take a look at this inventory cost flow problem. We've got the accounting records of Wall's China Shop, and they've given us the information here, which includes beginning inventory of $33,000 made up of 200 units at $150 per unit. And then we've had these transactions. We've had a purchase for cash of more units, another purchase paid with cash for more units, then we had a sale made in cash of 410 units. We paid $38,000 for salaries expense, and we paid cash for income tax at the rate of 25% of income before taxes. Requirement A says compute the cost of goods sold and ending inventory assuming FIFO, LIFO, and weighted average cost flow. And I'm going to work that for you, but only the LIFO portion. Now, before we start, let me delete this, and we'll put that in a minute here. Before we start, I want to just give you, here's an example of a cost of goods sold calculation. Okay? And basically what happens is you take beginning inventory, you add your purchases to come up with cost of goods available. And then you have to figure out what's the value of finished goods and what's the value of cost of goods sold. So the point of this little example is that we need to recognize that cost of goods available will be the same regardless of the method we use for valuing inventory. I mean, the costs are what they were incurred, the value of what was in beginning, whatever we gave up to purchase new purchases. And then determining finished goods or cost of goods sold, you can think of that as an allocation of cost of goods available for sale. And the dollar amount of finished goods and the dollar amount of cost of goods sold will change depending on which method you use. Okay, so with that, let's put this information on the screen. Let me slide the screen for you. Okay, so it's best to put a schedule like this together where you can see the layers that have occurred. And valuing inventory with FIFO or LIFO is very much a layering approach. So we have the beginning inventory, that's one layer. The first purchase, that's another layer. Second purchase, that's another layer. So what do we know? We know that the cost of goods available, right? We could put in the units here. The beginning was 220, and then we added 150 plus 160, right? So that total, just put an underline, and I will say, grab the value of those two cells, is equal to 530 units. And we could put the dollar amount in, 33,000 and the 23,250 plus the 25,600, or we could just rely on what we have in the schedule here and put it in directly. It's 81,850, but I'll do it the long way. I'll say take that value times 150, and then take, and this one I can't do, I can't just take the 310 times a value, so I'm going to have to say take 150 units times 155 and add 160 units times 160. And when I get that, I'll get the 48,850. Now when I sum those together, I'll just use the addition command, the plus command, I get 81,850. Okay, now let's format this a little bit better. Put a dollar sign on that one. Okay. And then we need to complete this. Well, we need to know what did we have left in finished goods. Oh, we sold 410 units, right? So if the 410 would go here, that represents the number of units that have to be reflected in cost of goods sold. Well, now we can just calculate the difference, right? Which would be equal to 530 less the 410. Okay? Or, 530 minus 410 is going to equal 120. Now, let's format this so it looks a little bit more aligned. Okay, so I know I had 410 units were sold, 120 in ending inventory. And by the way, you can reverse these. You can say equal cost of goods available for sale less cost of goods sold equals finished goods. There's nothing wrong with preparing the schedule that way. All right, so now what I want to point out is that we value FIFO or LIFO with a layering approach. So let me put this on the screen and readjust the screen. Okay, now we could either value cost of goods sold or ending inventory. In this situation, I think it's easier to value ending inventory first because there aren't as many layers, but you could do either one. Now, how do I know there aren't as many layers? Here's how I know. There's 120 units in finished goods. When I look at this schedule, I see that we had 220 in beginning inventory. Since LIFO means the last one in is the first one out, that means the last purchase is sold first, I know I have to count backwards. 160 units of the 410 units were sold came from that layer. 150 came from here. But I can simply look at the beginning inventory and say, oh, there's 120 left. We had 220. It all came out of that layer. So that value would have to be equal 120 times the 150 value. And once we have that, I can just simply force the cost of goods sold number, which becomes 63,850. Now, you don't have to do it that way. You could do the layering approach, right? You could come in here and say, all right, well, we sold 160 units and we purchased that at 160, then we sold 150 and you know at 155, and you work until you've accounted for 410 units. You certainly could do it that way. But I think sometimes it's easier to do the valuation with the approach that has the least number of calculations. And this one only had one, so I did ending inventory first. Okay, I hope you found that helpful.